If your business is generating over $80,000 in profit this year, you could be handing over $10,000 to $15,000 extra dollars to the IRS every single year. Not because you did anything wrong, but simply because of how your business is taxed. Today, we are going to walk you through one of the most powerful and most misunderstood tax moves available to small business owners, the S-Corporation election. We're going to cover exactly what it is, who qualifies, how much you can realistically save, and the number one mistake that gets business owners audited. Just stick around, because there's a very specific deadline coming up, and if you miss it, you're locked out for the rest of the year. Let's start with the most common misconception. An S-Corp is not a type of business entity. You don't create an S-Corp. An S-Corporation is a tax election. It's a special status you request from the IRS, and it changes how your business income gets taxed. Think of it this way. You already have your business. Maybe it's an LLC, maybe it's a corporation. By default, the IRS taxes businesses in a certain way. When you file an S-Corp election, you're telling the IRS that you want to be taxed differently. And according to the IRS, S-Corporations pass corporate income, losses, deductions, and credits directly through to their shareholders. Those shareholders then report all of that on their personal tax returns at their individual income tax rates. This does two very important things. Number one, it eliminates double taxation. The business itself doesn't pay federal income tax. The income flows straight to you. Number two, and this is the big one, it gives you a way to split your income. One part comes to you as a salary, and the second part comes to you as a distribution. And that distinction is where the real tax savings live, which we're going to break down in detail in just a moment. Alright, let's talk about why so many small business owners elect S-Corp status. The one major reason is the self-employment tax. If you're currently operating as a sole proprietor or a single-member LLC taxed as a disregarded entity, every dollar of profit you earn is subject to a 15.3% self-employment tax. That covers Social Security and Medicare. Let's say your business earns $150,000 in profit this year. As a sole proprietor, you owe 15.3% on most of that. That's roughly $22,000, just in self-employment tax, before the actual income tax. Now let's see what happens when you elect S-Corp status. As an S-Corp owner, you are required to pay yourself a reasonable salary for the work you do in the business. Let's say that a reasonable salary is $80,000. You pay payroll taxes, Social Security, and Medicare on that $80,000 salary. The remaining $70,000 of profit comes to you as a distribution. Now here's the key. That $70,000 distribution is not subject to self-employment tax. You still owe income tax on it, but not FICA, not payroll taxes. Now let's run the numbers again. As a sole proprietor, $22,000 in self-employment tax. As an S-Corp, paying yourself $80,000 in salary, roughly $12,240 in payroll taxes. That's a savings of approximately $9,700 per year. And if your profit is $250,000, $300,000, you're looking at savings of $15,000 to $25,000 every year. Now, I want to be very clear about one thing, because this is where a lot of people trip up. The IRS requires that the salary be reasonable, and we're going to explain this reasonable salary concept in Chapter 6, because getting this wrong is the number one way S-Corp owners invite an IRS audit. So you like the sound of those savings. Let's talk about whether you actually qualify. According to the IRS, to elect S-Corporation status, your business must meet all of the following criteria. 1. Your business must be a domestic entity, formed in the United States. 2. You can have no more than 100 shareholders. 3. All shareholders must be U.S. citizens, permanent residents, or resident aliens. Corporations and partnerships cannot be shareholders. 4. Your business can only have one class of stock. You can't have preferred shares and common shares with different rights. 5. The business cannot be an ineligible entity, which includes certain financial institutions, insurance companies, and a few other specific types. Now here's something a lot of people don't realize. LLCs can also elect S-Corp status. You don't have to be a corporation. If you have a single-member LLC and you're a U.S. citizen, you automatically meet the shareholder requirements. Multi-member LLCs just need to verify that every member qualifies. Now this is where I need you to pay very close attention. The S-Corp election is not something you just file whenever you feel like it. There is a strict IRS deadline. According to the IRS rules, you must file Form 2553 no more than 2 months and 15 days after the beginning of the tax year you want the election to take effect. For most small businesses using a calendar year, meaning your year runs January 1st through December 31st, that deadline is March 15th. But in 2026, March 15th falls on a Sunday. So the official deadline for the 2026 tax year is Monday, March 16th, 2026. If you miss that deadline, you usually have two options. You can request late S-Corp election relief by providing a reasonable cause explanation to the IRS, or you may have to wait until the next tax year for the S-Corp election to take effect. There is a relief provision too. If you have what the IRS considers a reasonable cause for filing late, you can also request retroactive approval. That gives you up to 3 years and 75 days after the intended effective date. But that's a lot more work, there's no guarantee of approval, and it's a situation you want to avoid entirely. So if you're watching this and thinking the S-Corp election might be right for you, the time to act is now, not next month. Alright, we promised you that we would come back to the reasonable salary issue. And this is important. The IRS is well aware that S-Corp owners can reduce their payroll taxes by paying themselves a low salary. So they watch for it. When the IRS determines that an S-Corp owner's salary is unreasonably low, they have the authority to go back and reclassify those distributions as wages, which means you would owe back payroll taxes and penalties. Multiple tax court cases have upheld this authority. So what is reasonable compensation? The IRS defines it as the amount that an unrelated employer would pay for the same or similar services in the same circumstances. There's no exact percentage rule. No magic 60-40 formula automatically works. It depends on your industry, your role, your hours, and the going market rate for what you do. Here are the 3 most common mistakes we see. Number 1. Paying yourself zero salary and taking everything as distributions. This is the biggest red flag you can wave at the IRS. Number 2. Using an arbitrary split, like 60% salary, 40% distribution, without any documentation to support it. Number 3. Running payroll improperly, or not at all. As an S-Corp owner-employee, you must run real payroll. You can't just move money in and out of your business account. Getting the reasonable salary right requires knowing your industry's compensation benchmarks, setting up payroll correctly, and documenting your rationale. This is one of the main reasons that business owners shouldn't be doing this without professional guidance. Now, let's bring this all together. The S-Corp election is a powerful tool, but it's not the right move for everyone. Here are 3 questions to ask yourself right now. First, is your business's net profit consistently above $80,000 per year? Below that threshold, the cost of running payroll and filing a separate S-Corp tax return often wipes out your savings. Second, are you currently paying self-employment tax as a sole proprietor or single-member LLC? If yes, you are the exact person the S-Corp election was designed for. Third, are you willing to take on a bit more administrative responsibility, like running payroll, filing a corporate return, and tracking your shareholder basis? It's not complicated, but it does require discipline or a professional to manage it. If you answered yes to all 3, there's a very good chance the S-Corp election could save you thousands of dollars this year and every year after. The S-Corp election is one of the most impactful tax decisions a small business owner can make. But it only works when it's done correctly. The right salary, the right payroll setup, the right timing. If this video helped you, please do subscribe, because we put out new content every week on tax strategy and bookkeeping for small business owners just like you. I will see you in the next one.